Good afternoon, ladies and gentlemen, and welcome to the SDI Group PLC preliminary results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company, and we will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you'd be so kind to give that your kind attention, we would be most grateful. And I'd now like to hand over to Mike Creedon, CEO, and John Abell, CFO from SDI Group. Good afternoon to you both.
Good afternoon. As you know from your research and also from a number of these meetings, I'm Mike Creedon, the CEO of SDI Group. John and I will go through the investor presentation with a Q&A at the end. If after this meeting you still have any questions, do not hesitate to contact me. I'm sure a few of you have got my email address, but it's mike@thesdigroup.net, and hopefully I'll be able to provide you with some answers. As you can see, this is not a recorded message, so I'd like to turn off the camera as it will make your slides a little bit bigger. There we go. Okay, yeah, so we'll go through onto page 2. And John and I will cover the following: the board of directors, group overview, 6-year track record, financial year 2020-21, which has just gone, followed by some operational highlights and outlook. And now at the end of this presentation, there's an appendix, which includes details of the 9 business units and the latest capital structure. And if we just go on to now the board, thank you. The board structure has been discussed many times over the years, and bios are within the investor presentation, and also our bios are on the website. Therefore, I propose to move off this slide, but there's just one sort of short comment I wanted to make, which has come out of a number of investor meetings this week. The question was raised about succession planning and whether additional executive and non-executive directors are required within the SDI Group. In my opinion, we have the right mix for now. But this is an agenda item for a nominations committee meeting, which all listed companies have, and I'm sure we'll be discussing it over the next few months. So go to the next slide, John. Thank you. And now we're looking at the group overview. We've used this diagram over the years to give a quick overview of the sectors and the business unit within these sectors. We've added another piece of spaghetti due to acquiring Monmouth Scientific and Uniform Engineering during 2020-21. These will be discussed later in the presentation, I think on page 17, if I've got my numbering right. At the back of the presentation, as I've already mentioned, there's an appendix which gives you additional information on each business unit, but further information can be found on these 9 business units on their own websites, but also on their social media links. In the bottom right-hand corner of the presentation, I just want to make a few comments on that. It's a very important question. Where are the strengths within our business model? The first point to say is a decentralized structure for a rapid and detailed response. What's that mean? That we hand over the day-to-day running of all the autonomous units to our local management teams. This gives them a quick but a managed decision-making process, thus eliminating head office delays from myself, John, or Jonathan, Jonathan being the new group financial controller. All businesses were profitable and cash generative throughout the financial year 2020-21. John will expand on that when he goes through his financials. We have a diverse portfolio of business units, therefore we're not reliant on a single sector or region for revenues and profits. We have a level of future-proofing within our sectors because we supply a range of products that have been standard products for very many years through the, sorry, I've lost my point, for those sectors over a number of years. Examples of this would include gel documentation systems, chillers, water purification units, and finally chemical dosing and control systems. These are all found in our subsidiary companies. I would also like to add that a good part of our revenue is also from a range of OEM products, again with a long life. What does head office provide? They provide a cash source for investment in organic growth and acquisitions for our business units. I'd like now to hand over to John, who will run through the 6-year track record and the financials.
Thanks, Mike. So moving on to a very nice and colourful slide here. You can see that in the last year in the right-hand bar of each of these graphs, our revenues increased, our operating profit increased, our cash generated from operations increased, all of them throughout, so notwithstanding the epidemic. And in fact, our growth was faster this year than it has been over the past 6 years, which was already pretty good. So revenues up 43%, adjusted operating profit, in fact, all profit lines up somewhere between 60 and 80%, and cash generated from operations up 127%. So very strong financial performance. See, the share price responded to some extent. So it's been a good year. We'll go into a bit more detail in the following slides. So full year 2020-2021 financials. Some highlights here where I've already said them, in fact. Revenues up 43%. Now that includes 19% organic growth, and we'll go into some detail on that. And the rest was growth from acquisitions, both last year's acquisitions and this year's acquisitions. Profit lines up, as I've said, very strongly, and cash generated from operations also sharply up. Delving in a little bit into our 2 reportable segments, these are digital imaging, where we have 2 of our original businesses, Synoptics and Attic Cameras, and an acquisition from 2019, Graticules Optics. Their turnover was up 43%, so fully in line with the total company, up to 15.8 million. Digital imaging segment accounts for 45% of group revenues. Operating profit was up to 5.2 million from 2.4 million. And in particular, this segment benefited from orders of cameras from a global OEM, actually based in China, for use in PCR machines. So these are the polymerase chain reaction machines that are used for testing for COVID in particular, but more generally for proteins and DNA. So we've had a series of contracts throughout last year, and these we consider to be one-time contracts. They're clearly related to the COVID pandemic. They go into the current year, 2021-22, but last year we had significant sales in Attic Cameras from those. We also had growth in Synoptics and a modest decline in the Graticules Optics business. In Sensors and Control, which includes mostly newer businesses for us, including Centec, Astles, ATC, Chell, and the new acquisition of Monmouth, turnover again was up 43%. That was largely due to the acquisition of last year, or in 2020, of Chell Instruments, and the 2021 acquisitions of Monmouth Scientific and Uniform Engineering. Organic growth in this pandemic year was negative 1.4%. So there, growth at MPB was very strong. They sell flow meters, some of which went into ventilators that at the start of this pandemic were in high demand. And we had modest declines in Centec, in ATC, in Chell, and a slightly larger one at our Astles business, where their revenues are about 50% in service, and there wasn't much service activity available to us for a lot of the year last year. Another highlight of Sensors Controls was the acquisition of Monmouth Scientific in December, and followed very quickly by Uniform Engineering in January, and Mike will talk about that in a while. On the income statement, I'm not going to go into too much detail. It's available to you in our RNS. I've said already revenue's up 43%, and most of our profit lines all up somewhere between 60 and 80%. So including my favorite, which would be the adjusted diluted earnings per share line, which was up 74% to 5.97 pence. There's a quick revenue bridge. So last year, 24.5 million of sales. This year, up to 35 million of sales. Now, part of this was due to acquisitions, so 2.5 million of additional sales from Chell Instruments purchased in 2020, 3.7 million from our 2 acquisitions of this year. On top of that, we had 19% organic growth, but that was focused on especially the 6.1 million pounds of specific one-off COVID-19 related contracts that we've talked about. So for attic cameras into PCR machines, and at MPB for flow meters going into ventilators. So you can see that if we hadn't have had those contracts, then organic growth would have been slightly negative for the group. Going to move on to the balance sheet and specifically our cash situation. On the top right, there's a box explaining that we started the year with a net debt position of about £4 million. At the end of the year, we finished with £751,000 net cash. That's that is cash less bank debt. So we're ignoring leases in this box. So quite a swing from negative 4 million to positive 0.8 million. What we should note, though, is that we hadn't paid at the end of the year for an earnout on the Monmouth Scientific acquisition of 2.35 million. So if we brought that into the equation, our net bank debt, including that item, would have been negative 1.6 million pounds. But having purchased two good acquisitions during the year, so a strong cash flow situation. At the end of the year, we had £5 million of unused bank facility, and £3.8 million of cash. And that's before, though, we paid for the £2.35 million earnout payment. We paid during the year £6.6 million in cash and shares, including the earnout payment after the year end for the 2 acquisitions. At the 30th of June, the month just finished, we'd already paid the earnout, and our net debt was down to 0.3 million. And in fact, as we speak, we're in a positive net cash position. And this is more or less in graphical form the same thing. We started the year with 4 million of net debt on the left. Cash from operations and took us very positive, including a very positive movement in working capital, which released 2.8 million pounds of funds. Now that, I have to say, is almost exactly the amount of customer down payment we'd received for 2022 shipments, or this year's shipments, for attic cameras going into the customer making PCR machines. So that's a one-time favorable cash flow that we had last year, and which sometime this year will probably reverse out and become negative. You see also on the chart the 4.1 million of cash we paid for the 2 acquisitions. So finishing there for the year at 0.8 positive. Again, there's a cash flow table here, but it doesn't add very much, just to confirm the benefit of the increase in customer down payments that we had during the year of 3.5 million in total, of which about 3 million was for the one particular customer. I'm going to pass back now to Mike for some operational highlights.
Okay, you've got me right to the end of the slides now. So operational highlights now, look. So before we move through the slides, what I want to do with this presentation, I'd like to give you a bit of an explanation of what head office did throughout the COVID year. As you all know from my bio, for many years I've been involved in finance and involved at the front end of small businesses, both listed and unlisted, having cash flow issues. Therefore, I understood the steps required at the start of the pandemic. So John and I, in March 2020, which John really took the stance of drawing down our bank facility, and then we introduced a 13-week rolling cash flow forecast, supported by short weekly reports from the business units. This information was sent out every Friday afternoon to the main board and the subsidiary directors. And very quickly, it became apparent that the group was throwing off high levels of cash. Therefore, this detailed level of reporting was no longer required. So my role throughout this period was to support the directors and the senior managers of the businesses. They're very good at managing their businesses and solving problems, but they do require some comfort from head office. To explain this sort of statement, really, we did have a number of businesses who found it tough during this year. Staff within those businesses, they're not silly, or they saw closures of companies on the news every day, and of course they've become concerned about their job security. So I was there sort of still in my car driving around the service to inform them that the group overall was highly profitable and we had sufficient cash to support their businesses for the foreseeable future. And that takes away the worry and stress from the staff. But now, as a real good positive, excuse me, we've seen that these units are very strong and they've come out of the pandemic very, very well. In the final slides, I'm going to look at some operational highlights, which include COVID-related contracts and acquisitions made within the financial year. And then what I'll actually do then is to have two concluding slides on our priorities for 2022 and outlook. So if we move on to the next slide, after that short interlude, and we have Attic cameras now, and page 15. This is a one-time OEM contract, as John has stressed, and it's to supply a customized CCD camera using real-time PCR DNA amplification for COVID testing. This has given SDI a massive boost in profits and cash over this year and will continue throughout this current year. And we're assuming that this will not continue in 2023. The contract did give us some issues regarding capacity and output, which we were able to resolve quite quickly. We relocated Attic Lisbon to a larger facility on the first floor of the building in December 2019. I think we did mention that and showed a few diagrams in the annual report of last year. A short while ago, we agreed terms with the landlord on the ground floor of that premises. And what we're going to do was just shelve it for future expansion. But what we've done is taken the decision to use this additional space to accommodate finished goods and shipping. Additional staff have been recruited on short-term contracts to enable Attic Lisbon, while Attic in total, to deliver the output levels required by the customers. Now, for the second year running of presenting this, we've been presenting on Investor Meets Company. I'd like to offer my thanks to Steve Chambers, the CEO of Attic Cameras again, and his team for a transformational year for Attic Cameras and also SDI Group. And then we move on to the next slide, MPB. As you're aware, in last year's annual report ended April 2020, a substantial COVID-related contract was placed on MPB, and it's a 40,000 flow meters, so sort of very large glass tubes to be built into 20,000 ventilators. The head contractor was an existing customer of ours, which was a company called Penland, but it was a consortium which included McLaren, Formula One, and Ford. Ford were heavily sort of involved in us and actually camped in our place for about 6 months. And I must say, thanks to Ford Logistics, because there is no way in a cat and a house chance we would actually achieve this level of output by ourselves. And we've learned a good lesson from these guys coming into our plant. During this period, we also took an opportunity to invest in MPB for the future. So what we've actually done is put in a more sophisticated IT infrastructure, nothing that big, but it does include MRP and an integrated stock system, which is what we needed, and most of our businesses have got that. Also, we added some additional investment in a glass tube washing plant, which really is just a more expensive dishwasher like you've got at home, but it serves the purpose on the glass. And also, we invested in a laser engraver because people wanted serial numbers, barcodes, and QR codes on the glass. And it does create a lot better sort of quality and image for MPB. And then the business has returned now to its normal output levels, which we always knew it was going to have this one-off contract, but it's in a strong position for growth going forward. So it was a very good exercise, and very profitable for us. Also, it was a good learning curve for Monmouth and its team. Can you flick the next page then, John? And we're on to Monmouth. Okay, so SDI announced on the 2nd of December the acquisition of Monmouth Scientific, paying, I think John's already mentioned, 6.6 million for the business, and that includes 2.35 million as an earnout. The acquisition was funded from cash and SDI's existing debt facility. Monmouth Scientific is a manufacturer of biological safety cabinets, fume cabinets, laminar flow cabinets, and clean rooms. There are many end markets for this equipment. There's laboratories, pharma companies, electronics, medical. And it's based in Bridgewater in Somerset. Monmouth did see a strong demand for its biosafety cabinets during this financial year. But the product mix is returning back to its pre-pandemic mix. The acquisition is in line with our group strategy of acquiring businesses with complementary technical products. David Pomeroy is a great guy. He's still around, and he's CEO, and he's been running this business for 17 years. It's a great business. It's very similar to the culture of all the other businesses, and like all the other businesses, we are going to invest for growth. Firstly, one of the reasons that David and Lisa sort of sold the business is they've got about 33,000 square feet in 6/7 units scattered around Bridgewater. The reason why it's that big, because they do build big products, clean rooms, fume cabinets, laminar flow cabinets, etc., as we've already mentioned. So it already signed up to have a purpose-built building on the outskirts of Bridgewater. If anybody knows the M5, there's a Morrison's. It's a mile on Morrison's along the M5 on the left-hand side going to Cornwall. It's just near there. It's due to complete in June 2022, 48,000 square feet. Of course, it's a hell of a commitment for a husband and wife, because when you've actually got a purpose-built building, it's a 15-year lease with no break clauses. So it's not like your standard 3 to 5 year leases. So it's a big commitment, but that's what we like doing. We like investing for growth. Another area which is of interest for them and for us is they would like to enter the US market. We've got a subsidiary, Synoptics Inc., based in Frederick, just outside Washington. Only 5 staff, sales, marketing and service. But what we use is manufacturers' reps, which are commission-only reps. So we're currently undertaking a market research with the assistance of our US staff to say, could this be a lucrative business for Monmouth Scientific? Well, hopefully it will be, and the sales manager, Lewis, within Monmouth is very proactive in trying to go forward with this new market for us. As with all acquisitions, we ask the sellers if they know of any other businesses for sale. In this instance, we were led to Uniform Engineering, which is about 7 miles outside Bridgewater in a place called Highbridge. Not within the science and technology sectors we've actually been buying businesses over the years, but it's a fabrication business. It's a good addition, as we would have in-house fabrication facility to be used by a number of other businesses. We use third-party fabricators in Synoptics for the gel lock systems, and also we use it for applied thermal control for their chillers. But it was interesting, I suppose, why I made the decision is when we bought Shell Instruments. They are an engineering firm, 30 engineers out of 34 staff, and they do everything from start to finish. They've got in-house metal fabrication, CNC machines, and they have a limited contact with third-party suppliers of engineering services. So, that's actually pushed it over, thinking it'll be a very good facility for us going forward. Currently, it does about 25% of Monmouth's sales, and the other balance is third-party sales. It turns over about 1.1 million, with profits of about £100,000. We acquired the business on a 3.5 multiple, together with net assets. I'm positive that this business is a good investment, and we've got potential to grow it through intercompany and also third-party sales. Let's move on to the next slide. It is our priorities in FY22. You can actually read this later, but I'm going to pick out a couple of points, a number of points on here, and give some sort of flesh behind it. All our businesses have had a good start to the financial year in the months of May and June. A cracking start. Some of the ones that really suffered through COVID are coming in quite strong. So I'm really pleased that we actually supported and backed these guys through this period of uncertainty. We've used a government slogan. I must say, John used this government slogan, build back better. That was introduced by Biden, and then Boris used it. For us, it's investing in our infrastructure, skill base, and R&D growth. So in a way, it is for us, and that's what we do right the way through this presentation. As we've said all along, is we invest in our businesses. We buy businesses which are lean, mean. The founders generate very good profits and cash, and we continue to work to grow those businesses for our behalf. But a lot of the business founders are still involved in us. Our subsidiary directors have always had a good handle on the cost control within the businesses, and this is proven to be the case during the pandemic. But now we're looking to invest in our businesses going forward. And just two areas to highlight on that. One is marketing, and the other one is on travel. We need to start attending shows such as Analytica, which is a very big life science exhibition in Germany. I think three or four of our companies actually do attend that show. So we're looking at whether we can consolidate it. Maybe not, because it's just like the NEC, 6 or 7 rooms. So we might not be all in the same rooms. This has been cancelled for 2 years, but we have to get back to show our face in the sector. And the other area is travel. That was a big saving for us last year. But this year, we're going to have to put that cost back into the budget again. A good example of that is that 50% of ASTL's revenue stream is from servicing equipment around the world. And that's been restricted during the pandemic. And additionally, we've found it difficult to demonstrate a number of our products due to their complexity. Especially a good example is Autocol, which is sold by Synoptics. And what we've been using is communication platforms such as Zoom, Teams, WebEx, but we do require the face-to-face meetings. On that point, John and I have had 2 face-to-face meetings this week with institutional investors. It's just a sidetrack really, which is actually pleasing, but also worrying for the city, as we were the first meeting since lockdown for a number of these institutional investors. During the pandemic, this is a question that came out of the city on quite a few occasions. It's during the pandemic, we've seen a strain on our supply chains, which our subsidiary management have actually managed very effectively. But I just wanted to give a couple of examples where we're actually seeing this sort of strain. Firstly, is on the shortage of electrical components, a mouthful, which is sort of semiconductors, but also, just to highlight fans, cooling fans, and it's very difficult to get those. So we've actually increased our stock base there. And the other one, as you have actually seen on the news, is increase in sheet metal, going up by 10, 15% because of the restrictions on China. But some more of concern is copper, going up by 30%. In a number of these cases, we've managed to pass these costs onto our customers. So that's just to give it a highlight, a couple of sort of details around that sort of slide, and then the rest of the points are sort of you'll understand. So if we move on to the next slide, acquisition process. We've seen this on a number of occasions. Last year's Investor Meets Company, and also within the annual report. But I still like to go through this because this is what we actually do. Is we're an M&A company, and why join? Well, owners sometimes just want to crystallise their shareholding for a number of reasons, And in many cases, it's just not for retirement. It's not a reason. So they would still like to continue their business, to run their business, making profits and cash, but under the ownership of SDI. Why they like us is because we run all our units as autonomous units, standalone units, run by the same management team before he or she sold the business. And what we do is focus on growth and investment, as you've seen throughout this presentation. The acquisition criteria hasn't changed. We're still looking at scientific and technical with a manufacturing bias. I must say that the fabrication is a bit of a sideline, but I think it would be very good for us going forward in a vertical market for us. We're looking at niche sectors with strong export revenues. Monmouth is not so strong in the export, but we know we can get there with the assistance of the subsidiary directors of the other subsidiary directors. All businesses are profitable and cash generative. They have a strong track record, which makes my life doing due diligence a lot easier. Good, solid management team. We offer a fair price, which is between 4 and 6 times EBIT, and we have a very, very good reputation as a good acquirer. After the acquisition, we group all the banking into HSB centralised banking, which is run by John. All the businesses still, as I mentioned right at the start, retain autonomous units. We operate a very flat structure, i.e. the subsidiary management teams will receive the same board report as the main board directors. So we don't hide anything from our subsidiary directors. And also when we have consolidated budgets, they receive the same pack. So it's a very flat structure. And what we try to do with these businesses in the short term, right the way through to the long term, is to give these businesses financial support if and when required. John, can you explain about financing for future acquisitions, which we've been actually mentioning throughout the week?
Yeah, certainly. So, in the past, SDI, going back now 4, 5, 6 years, we used to have to go to the city every time we wanted to make an acquisition because we didn't have the cash flow and the cash ourselves. But more recently, we've as we've started generating lots of cash ourselves, we haven't had to do that quite so frequently. And in fact, the last time we went to the city was in February of 2019, when we took £2.5 million at the time of our Graphicals acquisition. And that really funded the acquisition that came immediately afterwards. Since then, our cash flow has increased, and we're now in a situation where we have roughly a net cash, net debt zero at the moment, and we're generating lots of cash. We have available facilities with our bank, and the bank is willing to offer us a bigger facility. So in fact, we're now at the position, and in fact have been since, for the last 2.5 years, in fact, of probably being able to finance most acquisitions that we want to do. I expect that we'll sign up for a bigger facility, and generally the model is we buy something, we increase our leverage at that time, and then pay it off gradually, or pay it off as quickly as we can, and then take out a new one for more loans for a new acquisition. So I think we've got plenty of firepower now and available to us, and we're in the happy situation that we can use our own cash and debt capacity to finance acquisitions, which makes it easier, frankly. And of course, debt financing is less expensive than going to the stock market every time we want to pay out some money.
Right, cheers, John. Can you flick it on to the next one? This will be a very quick one. Acquisition. I said nice colourful chart. So what we've actually got there is 13 acquisitions since 2014. As John's actually said about funding going forward, we had 3 businesses we acquired using city funding. Centec, we raised £2 million at 8p a share. That was EI's VCT funding. Then we raised 4.8 million to acquire Astel's control systems at 13p a share. And then the last one, which was in February 2019, which was the Graticals, where we acquired sort of 4 businesses in that year. We raised 2.4 million at 34p a share. And the other 10, as John's actually said, are through cash, debt, and that's probably the way forward for us. So if we just go through to the remaining 2 slides, John, please. Thank you. Summary and outlook. So what we've actually got, strong financial results for last year, and with a good start to the new financial year, our new financial, sorry. We have an even stronger business model, which you can see is scalable and can accommodate further acquisitions. We provide all our business units with investment to grow. I think a good example is with Graticals Optics. It was when we acquired it in 2019, it was owned by, I think, a small private equity firm. It was a cash cow. It really needed investment in that business. So this year, we've actually signed up to invest. So we did stick to our guns on this. So what we're actually going to do, it's a business, chemical collection business. It's based in Tunbridge in Kent. We did look for another purpose-built another building to put it into. Couldn't find anything, so we went back to the landlords and said, can we gut the building we're currently in, which is on an industrial site, and what we're going to do is to put new chemical tanks, a clean room facility, together with a full fit out, bringing it up to modern day from the 1960s internal rabbit warren we've currently got. So the cost of that is going to be about 350,000, and that includes putting a clean room facility in via Monmouth Scientific. So you've got intercompany profits of about 45. So you can back that out. It's just over 300,000, which is a good investment. Phase 2 of that, I'll just tell you, if we can get a good return on that investment and the directors can actually increase the sales and the returns, then what we wanted to try to do was to increase the footprint by expanding on the site. But that is probably 2 or 3 years away. So the initial investment is to gut it and put a new facility in place. So if we move on, we operate in a diversified group, which means we are resilient to any changes in the market conditions, such as COVID, and you've actually seen this throughout the presentation. With M&A, we're very, very disciplined in our approach, even in the case of Uniform Engineering, where we acquired it at £350,000 plus the assets. We still have the same 18-point approach, and we will continue with that. 2021-22, we expect this to be another strong year with growth in sales, profits, and also important to me is cash generation.
That's brilliant. Mike, John, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and after the presentation is ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Mike, John, obviously investors have had the ability to submit questions throughout today's meeting, and perhaps, John, if I may, hand back to you just to read the questions where it's appropriate to do so, and your response also. That'd be great.
Yeah, sure. So thanks for the questions. We'll try and answer them all, or we'll try and at least give you a reason why we're not answering them. So we'll go through one by one. Got a question, Mike, from Gilbert, who says, with the benefit of hindsight, have any of your acquisitions not lived up to your original expectations? If so, which, and any lessons learned?
No, they've all lived up to our expectations, i.e. they are growing. But I will actually say, because we have had this on a number of occasions, what acquisitions did you have a problem with? Whether it was just one we've had over the 13 acquisitions since February 2014, and that was Thermal Exchange, whereby we bought a business, we thought it was a nice range of products, standardized products, but it was only when we got into the door, bought the business, that we found the sales director went out with a blank sheet of paper with the development director, and every product was bespoke. So what we had was a bit of a problem standardizing all the products. So we've got a very, very good R&D team and applied thermal control, standardized the products, and there we go. So we're back to a business doing very well, selling both applied thermal control products and thermal exchange. It's just one of these problems you get, and we got through it. Apart from that, everything's done very well.
Thanks, Mike. Next question from Andy M. Can you talk about the M&A pipeline? How is that evolving, and do you see M&A as the driver of future growth?
Yeah, I'll answer that then. So currently we have a pipeline. We're looking at sort of 3 acquisitions at the moment. What I actually thought through the pandemic, I thought people would just hold their hands up and saying, I don't want to run my business anymore and sell it. That's not coming through. Also, I did actually think that soon that's going to pay for that bill, and he'll probably sort of align capital gains tax to income tax. He may not. So I actually thought people might sell because of that reason. Again, not. But we're still finding acquisitions coming through from all sources, both from our subsidiary companies, third-party M&A companies, corporate finance companies, and our independent M&A chap. So we're finding them. Like I said, we've got 3 on the go at the moment. They may crystallise, may not, but I'm kept busy.
Thanks. Another question from Jamie K. Roughly, what is the lifetime of an attic camera before it needs replacing? Can we expect that a good percentage of those consumers will return to the business after the COVID contracts? Shall we have a go at this? So we're selling a lot of cameras currently that are going into PCR machines. The PCR machines, obviously, it's a flexible instrument. I think a lot of them are dedicated to COVID at the moment. And when the current pandemic is finished, we don't know whether there'll be a kind of world surfeit of PCR machines around. So we don't know really whether they'll get the lifetime and whether there will be replacement PCR machines afterwards, or replacement cameras going into those PCR machines. So it's very difficult for us to say that this is the start of a continuing stream of revenues directly from that. The answer is we don't know. As I said, a lot of these are going into China, and again, there it's very difficult for us to know. They're probably going into Chinese state-type institutions. We don't know whether that will lead to anything else. We're obviously doing our best both to get designed into other PCR instrument makers and to other instruments that are not PCR instruments, but nevertheless a part of the kind of life sciences industry. So we can't say today that these millions of pounds worth, or millions or thousands of units of cameras will become a long-term revenue stream. We hope so, and we're trying to maneuver ourselves to be able to do that, but we can't promise that. Tricky question here, one for you, Mike, maybe, from MGM. Do we have a succession plan in place for the chairman, Ken Ford? And would we be able to get someone as exceptional as him?
I think I already mentioned that. I knew this was going to come up. So, like I said, we like all listed companies have a nominations committee. You and I and the 3 non-execs filled out the standard forms, which we do every year. And when the next nomination committee meeting is held, which is chaired by Isabel, then it's on the agenda. I can guarantee, because I'll actually put it, that we need to look at succession planning. So it's not just Ken, it's all of us, of what we need to do. That, and there must come a time when me and my car can't go around all the subsidiaries, and then we need help there. So it will be addressed, and it's been, and that's why I raised it today, because I thought that question would come up.
Very good. And again, Mike, what sectors are you looking to acquire businesses in now?
I think I'm just going to answer what you've actually been saying to the city, and that is we split our business model into 2 sectors: digital imaging and sensors and controls. When we look at this business, let's say when we have a board meeting on Monday, we look at each individual business. And so for me, I'm not overly concerned whether it's a digital imaging business or a sector controls. As long as it ticks our acquisition criteria, then we will acquire that business. And if it does require another sector, we'll open another sector. But it shouldn't impede us acquiring businesses because it doesn't actually go into one of those two areas.
Thanks. Question maybe for me from Jonathan H. What is your return on total invested capital? Well, we've looked at this. We've been looking at this for several years now. What we came to realize is there's no single definition of return on total invested capital. So I could give you a number, but it wouldn't be comparable necessarily with those of maybe some of our bigger peers. We do measure it. We measure it for each of our businesses and for SDI in total. Tell you, I'm sitting at the end of June. I've got the June results in front of me, and I can tell you it's never been as high as it is now. So we're in a very strong position. The last time we looked at it and tried to compare with others, we found we were in a pretty favourable position. And in any case, if you like, compared it with our cost of capital, it's significantly in excess of that. So, I'm looking at a number which is in excess of 30% now. But unless you really know what's going into that, it's going to be tricky to interpret it, I think. Another question now from Jamie Kay, question about marketing. Which approaches will the company explore in marketing its subsidiaries and its products? For example, is digital marketing the main method, such as social media ads?
I'll answer that if you like. Yes, it is. We've got young people who are tuned to social media these days. They're using that marketing method. I think going to catalogues and that sort of ilk for marketing is out of date. But for us, as I said to you earlier on, we still need to attend exhibitions and do face-to-face sales. One of our big customers does require face-to-face meetings to explain how our products work. So I think it's a mix of everything, but of course, everything's going to digital these days.
That's fine. Question maybe for me. Paul S. asks, the house broker is forecasting a 5% fall in revenues for 22-23 and an 18% fall in EBITDA. Does that reflect internal budgets? Well, I'm happy to say we don't have a budget for 22-23. If we did, I think there'd be a lot of speculation involved. What we do know, or what we've kind of guided the broker to, is that we can't count on these one-time contracts going beyond this year. So we're going to have a good year this year, based in part on a one-time contract at Attic for these PCR machines. That's great. It's providing us with cash and profits, but we really don't believe. We don't know, but we don't believe that it's going to go beyond this year. If it does, that'd be very good. But our guidance has been that after this year, it's over, that particular one. So it shouldn't be surprising that anyone currently looking at our numbers will say we're going to have a great year 2021-22, and then a fall in revenues, which then generates a fall in profits in the following year. Now, it's our job, if you like, to manage those existing businesses and to manage that decline, but also, because we're an M&A company, to try and fill it with, as we would anyway, even if organic sales dropped, with acquisitions and new profits from new companies. So I think the fall in 22-23 does reflect our current thinking, but of course it's without acquisitions, and the game's not over yet, so we've still got plenty to play for. Do you want to add anything on that, Mike? I'm not sure if...
No, not at all. I think you covered it.
Happy with that. Okay.
The city everybody was expecting that is our job is M&A, at the end of the day, and I'm sure within this period of time, excuse me, we will find companies to cover that.
Yeah. And in fact, that's right. We put out an announcement in February that we had these contracts going into this year, and that we had to consider them one-time contracts, and we still do, in fact.
Yeah, we still did two acquisitions through COVID when people were working from home. Yeah, we still managed to actually do two deals. So I'm sure we'll be able to do the same.
Yeah. A question from Vivek S. Could you please speak to management's approach with respect to capital allocation? From the segment results, it appears to me that the digital imaging business has better margins and return on assets, notwithstanding one-off factors. However, the CapEx acquisition activity seemed directed towards the sensors and controls business. Do you expect, I just went off the page, do you expect returns on capital and assets to converge across the two businesses? Will this be a result of improving or growth in the sensors and control business, or is the imaging business benefiting from one-off factors? Thank you. So that's a complicated question.
Are you going to answer it or me?
Complicated, Mike, so you should answer that. So let me have a go, and you can add something. How about that? They're not quite comparable. For us, we're buying, we buy a business and then we'll slot it into those segments. As you probably know, the segments are there to provide information to shareholders about our businesses without necessarily going to the detail of the 9 businesses that we own. So we're not actively buying either digital imaging businesses or sensors and controls business in particular, but they do seem to slot into those categories. They generally are a little bit different, and it's also the case that the digital imaging businesses were the original businesses that SDI owned before it floated on the stock market. So they don't have the intangible assets that the sensors control business have, because we bought those much more recently. So I think you can't really compare them in that sense exactly. When we make an acquisition and when we invest in the businesses, we're not saying, okay, you're sensor controls, so we're going to invest less in that. I think every investment has to be made on its own merits. Mike, anything?
Yeah, I just want to sort of reinforce that. When I personally look at each of the 9 sectors individually, not as these groups. So every one of our subsidiary directors has to put forward a case why investment is required. I've just mentioned it today with Graticules, and we'll look at every case, every business on a case-by-case basis. But if you have a look at the history and look at our balance sheet and additions, we're not capital intensified throughout the business models, are we, John?
We're not. No, that's correct.
So therefore, it's just on a case-by-case basis for each business. So as long as we have these return figures in mind, as long as we can get a return which the board are happy with, and of course following on our shareholders, that's who we report to at the end of the day, yeah, we're happy to make that investment. We don't look at it on a sector-by-sector basis. It's on an individual company. This year the biggest one is going to be Graticules. Next year it's going to be probably Monmouth when they move into their new building. So that's it, I'm afraid. That's my answer.
Yeah, thanks. Philip R asks, what percentage of Monmouth's sales are service contracts? That's actually a fairly small percentage, because they, firstly, because they provide 5-year guarantees on their products. There are sales of equipment like deactivated carbon filters, so there's some of that, but it's not a huge percentage. Mike, is that right?
Yeah, that's correct. They do service equipment, but the bands, if you have a look at their website, all the bands have actually got is they commission and they install all their equipment. But service is not big for these guys, apart from, as John rightly said, is the filters. So all we're actually doing is sending out replacement filters. But a lot of this equipment doesn't need servicing. It just needs replacement of the consumable side.
Thanks. Question from Andrea M. What are the company's forecasts for organic growth this year? So we're growing organically for two, let's say, I can put it in two parts. One is our Attic camera contract, one-off contract, is going to be bigger this year than last year. So there's significant growth from that. And then we're expecting significant bounce back from lows on most of the other businesses following the kind of end of the COVID pandemic. So all of our businesses now are very busy. We're seeing significant growth, excluding one-off factors. And in fact, I was looking at growth from first 6 months of 2019 to the first 6 months of 2021, so 2 years, and we're getting significant growth above that kind of 2019 benchmark now. And we think that will only get better. Now, there's some element maybe of bounce right at the moment because some companies are coming back from lockdown, some consumers are buying more. But overall, we're in sectors that tend to grow. We're not sure what the overall level of organic growth is because we see 9 businesses growing at different rates in different years. But we certainly expect organic growth across the board, and we're seeing it right now. So we'll get organic growth over 2020, of course, and we're getting already good organic growth over 2019, except excluding those one-off contracts. So I think things are going pretty well at the moment. Gilbert is asking, what are the prospects for overseas M&A? Is that a way of entering new geographic markets?
We had an opportunity about a year and a half ago to acquire a business in France. It looked very good. It was slotting very nicely with Grassicles. But of course, with the pandemic, it locked down. And at the end of the day, they sold it to a French company. We have another couple we're looking at in the US, but we're restricted at the moment. The borders are not open. The planes are not in the sky. So there are plenty of opportunities in the UK. So let's stick to our home. It's a lot easier and cheaper for me to do due diligence in the UK. But if another opportunity opens up overseas, yeah, we're willing to look at it.
Thanks. Next question from John H. Is Pro Reveal gaining traction?
I'll answer that. No. So what we've done is invested a lot of money in Pro Reveal, we thought it was a brilliant product. It still is a brilliant product, but the market are not accepting that product. So what we've done is handed it over to a distributor who's actually looking after that now. The directors of Synoptics, Claire and Kate, are now focused on areas whereby we can actually generate a lot more profit. We were taking our eye off the ball with that product. This year, Synoptics has had its best year ever in over 30 years profitability, making £1 million. And they're focused on Autocol, which is the new automated colony counter within this Symbiosis brand, and also within Firestream, which is selling sort of boxes of water purification units and vacuum ovens. And also we've got the Gallencamp brand, as you well know. We bought that and we're trying to market products through that brand. So we've got a lot on the go at the moment. And Pro Reveal was too much of a distraction. It's still on the cards, but we can't see anything, especially through the pandemic.
Thanks, Mike. Do you want to say anything about the director share?
I do. Yeah, I saw that, and I definitely want to say about that. Yeah, Ken Ford and I sold shares about 3 or 4 weeks ago. I had no intention of selling shares. I sold 650,000 shares as I haven't got an expensive lifestyle, so the money is still sitting in the bank account. The reason is I got the advice of Ken and also FinCap. There was a big institution that wanted to come in called Dance Bank. They wanted between 4 and 5% of the shareholding. They tried to get it into the marketplace, and then they had no other way of getting any shares that coming to me and to Ken. I'm still here. I've still got shares and share options. I think the only good thing is for my 2 daughters, I can get them on the ladder. But apart from that, I'm here. And also probably taking advantage of entrepreneurs relief. But I wanted to actually say for that, because I got a lot of emails from retailers saying, why are you selling? And it was just to get people, just to get another institution on. For me, and that's the reason I did it. So I just wanted to say today to everybody, that's why I did it.
Thanks. David L asks, looking through noise of the pandemic and one-time orders, what kind of cash conversion do you think SDI should have on average? Well, there's no one single definition of cash conversion either. So I think the answer is slightly lower than 100% because we're a growing company and that mostly involves some kind of investment in working capital. But we're not a high capital intensive business, so close to 100%, but probably not quite 100%, depending on the particular definition you might want to take. Let's see if I've got the right one in front of me now. William D is asking, accepting the impact of COVID, do you have a high level organic growth rate that you're targeting? What is your budgeting process, and to what extent do you push back on any budgets proposed by management of the individual businesses? Mike?
Yeah, I can answer that. I don't think we actually set ourselves an organic growth rate. I'm of the opinion, as a finance director for many years, is you can't actually push a budget onto a subsidiary, because then it's demotivating and they say it's not my budget. But in the 10 years that I've been here, with the budgets coming through, we've rarely had to change or push back or argue with the subsidiaries coming through with the budget. What do you think, John? Because you've been in the seat now for 3 years, the FD.
Yeah, so I think that's true. That is what we do. I mean, we can have a good discussion on them sometimes, but we don't want to force something through and then fail. If we fail on it on a budget, then it would be our fault, of course. So we're happy with that open discussion with the subsidiaries. Mm-hmm. Let's talk about the high level. What level of organic growth rate are we targeting? Yeah, I think you said we don't really target one, because every business is going to be different in a different time period. So overall, I think and we've said it in the past, that high single digits sounds about right.
Yeah.
But we're in exceptional times as well. So even that, you can't count on it right now. Another question from Jonathan M. Now, since, as you mentioned, there are various ways of calculating return on invested capital, can you provide investors how you calculate it internally? Well, I can do that. So typically what we do is we take the adjusted operating profit of our individual businesses and the company itself and divide that by the ending invested capital in the businesses or in SDI. It's a fairly simple way of doing it. It allows us to at least have visibility across the businesses and over time, but it's not something we want to publish at the moment. And as some of our peers recognize, it goes up and down. In our case, it's recently been going up, but if we would buy a big subsidiary at a relatively high price, it might be diluted a bit. So but that doesn't mean to say that it's not a good acquisition. So we treat it carefully, but we watch it every month, in fact. William D is asking, would it make sense to sell any businesses and recycle the proceeds?
Oh, we've had that question before. Yes, of course. At the end of the day, I report to the shareholders. So if somebody actually comes across and can do a better job and get a return from that business, we're happy with that return they're going to give us, then we'd be happy to sell that business. We have to realise when we buy another business, we've got to get a revenue stream and a profit stream equal or better than the one we sold. So that's what we have to realise. We didn't have an opportunity a number of years ago, but they didn't come up with the funds. So yeah, we have to. We're always open to negotiation.
Next question, Jonathan H is asking, which business has the best growth prospects? I don't think we'd really like to nominate a single one there.
Yeah.
we've got many businesses that have very good growth prospects, and one or two which are very steady businesses but high return on capital as well. So we love them all. Andrea M, what are the main risk factors to the company's performance beyond the current year? Mike, you want to read them in the annual report?
I don't sleep at night sometimes. I can't think of any at the moment. I think we've had a cracking year last year, and ATIC's really come through. We've come through the pandemic really well. We know this year is going to be a good year. And I can't see anything really currently that is going to make me not sleep at night currently. I'm sure it will do, but not today.
Maybe to add, I mean, we're obviously very wary of making wrong acquisitions, so that is a constant concern. People issues, are risks, and we like to look after our people, and because they're what bringing the money in the end. So, but you can see a full list of our risks in the annual report. Andrea M, again, who do you see as your main competitors, and what differentiates SDI?
Well, it's quite straightforward, really. Our main competitors are many people who want to buy businesses in the trade sale. I think nowadays it's going to be private equity because they have loads of money. I always thought their sort of benchmark was the profits above £1 million, but they're probably going to drop that now. So I actually think anybody who's willing to buy business. But what interests people in selling to us is because we run the businesses as autonomous units. They're standalone businesses, and more importantly, we don't never back down on a deal, or we never change the deal, which people like. And if you look at private equity, you will not get all your money in a suitcase. It'll be in convertible loan notes or some financial instruments. We don't. We actually give cash, and if they want to take stock, then we'll give that as well. So I think we're a very good acquirer of businesses.
John, Mike, I might take this opportunity just to jump in, because you've been very generous with your time. We are through the hour, but you have actually taken every single question submitted by investors today. So thank you so much to those that have taken the time to submit the questions. Feedback's important as usual, I know, and I'll shortly redirect investors to provide feedback. But perhaps ahead of doing so, I could just hand back for a few closing comments, and then I will close the session.
Okay, I just wanted to say thank you. This is a very good vehicle to speak to retail investors. I do like going, as some of you know, like to speak face to face at ShareSoc and a number of these institutional meetings. But it's good fun to do this. I hope you enjoyed our presentation, and hopefully I look forward to seeing you face to face sometime in the next sort of 12 months.
John, Mike, thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SDI Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.